You walk into a bank. You hand over your paycheck. You see the balance appear on your phone. And at that exact moment, your money stops being yours in the way you think it is. Not stolen, not gambled away, just repurposed. Most people imagine their deposit sitting somewhere safe, a digital vault, your name on it, waiting patiently. That is not what happens. And right now, this matters more than it has in years. Because interest rates moved fast, banks are under pressure, and suddenly people are asking a question they forgot to ask for decades. What actually happens to my money after I deposit it? Let's slow this down and strip it to the bones. Start with a simple scene. You deposit $1,000. The bank thanks you. Your app updates. You feel richer by exactly $0, but calmer. Here's the uncomfortable part. The bank does not put that $1,000 aside for you. Legally, the moment you deposit it, the money becomes the bank's. What you now own is a promise, an IOU. The bank owes you $1,000 on demand. But the actual cash, it moves, almost immediately. This sounds alarming. It's also how the modern financial system survives. Banks operate on something called fractional reserves. Ignore the jargon. Think of it like this. For every dollar deposited, the bank only keeps a small slice ready for withdrawals. The rest is sent back out into the world. Loans, mortgages, credit cards, business financing. Your money is no longer sitting still. It's working. Or more accurately, it's being put to work by someone else. Here's where it gets quietly absurd. You deposit $1,000, the bank might keep, say, $100 in reserve. The other $900 is loaned to someone buying a car. That car dealer deposits the $900. The bank keeps $90, lends out $810. And this keeps going. Same money, repeated, stacked. From that original $1,000, the banking system can create many thousands more in loans. Not fake money, real spendable money. This is not a conspiracy. This is not a loophole. This is the system. And it works until it doesn't. Now pause and ask the obvious question. If your money is loaned out, what happens when you want it back? Most of the time, nothing dramatic. Because not everyone withdraws at once. Payments come in, loans are repaid slowly. The machine hums. Banks are not built for panic. They're built for predictability. This is where confidence quietly becomes the most important asset in the entire economy. As long as people believe their money is there, it might as well be. But belief is fragile. We've seen what happens when it cracks. When too many people ask for their money at the same time, the math breaks. No bank can hand everyone their deposits simultaneously. Not because they're evil, because the system assumes that won't happen. That's the trade-off. You get convenience, instant payments, interest, economic growth. In exchange, your money is always partially somewhere else. Here's the irony. The safest your money feels is when it's doing the most risk-taking behind the scenes. Now let's talk about the part people misunderstand the most. The bank is not lending out your specific dollars. There's no tag that says this loan came from you. Money in a bank becomes a pool, anonymous, interchangeable. Your balance is an accounting entry, a very important one, but still just numbers on a ledger. This is why banks can fail even when their apps look fine, because the screen shows promises, not cash, and those promises are backed by assets that take time to turn back into money. Mortgages don't liquidate instantly. Business loans can't be recalled overnight. Long-term bonds swing in value. Which brings us to why this topic matters right now. For years, banks lived in a world of near zero interest rates. They parked money in long-term assets that paid modest returns. Safe, boring. Then rates rose, fast. Suddenly, those assets were worth less on paper, not because the loans disappeared, but because newer loans paid more. Same cash flows, lower market value. This is how a bank can look healthy one month and shaky the next, and why regulators obsess with liquidity, not just profitability. Here's the contrast no one advertises. You're told your money is safe in the bank, and mostly that's true. But what's actually keeping it safe is not a vault. It's layers of systems, insurance, central banks, emergency lending, rules written after past disasters. Deposit insurance exists because this system failed before, spectacularly. It's the quiet admission that trust alone is not enough. Now zoom out. Your deposit doesn't just affect you, it fuels housing prices, business expansion, consumer spending, economic growth. When deposits flow in, banks lend more. When deposits leave, credit tightens. This is why fear spreads so quickly in finance. Money leaving one bank doesn't disappear, but the system feels it. And this is the uncomfortable math underneath everyday life. Your money is simultaneously yours and not yours, safe and in motion, stable because everyone agrees not to test it too hard. Most days, that agreement holds until something shakes it. So the next time you check your balance, remember what you're really looking at. Not cash waiting for you, but a promise backed by confidence, rules, and history. And here's the question worth sitting with. In a system built on trust, speed, and shared belief, what happens when people stop believing at the same time?